When I do my road shows and I speak in the region, I always show this slide to start with, because the question I have for many of you, including our own investors, is, did you miss this huge rally, right? And the impression I get, right, when I speak to our clients and even other investors is that many of them have actually missed this. There was a huge stock market rally that began from the first quarter of 2009 to where it is right now. So what Professor Jeremy Goh spoke about earlier, about buying when people are most fearful and selling when people are most greedy, I think it applies over here, because the first quarter of 2009 was the peak of the global financial crisis. Everybody thought the world was coming to an end, banking systems were coming to an end, but that was actually the best time to buy. But I think the other difference is also that between 2009 and now, we've had so many crises. You have the subprime crisis, you've got the global financial crisis, you've got the European debt crisis, you've got crisis in Greece, you've got the taper tantrum from the Federal Reserve. So if you were to open the newspapers for the last 5 to 6 years, chances are you won't buy anything, right? Because I think I've been in the stock markets, covering stock markets since the 1980s. And I think the typical traditional way of investing in the markets in the past have always been good news, you buy, recession, bad news, you stay out or you sell, right? But I think if you had applied that blue skies philosophy in the last 5-6 years, you would have completely missed the boat. Because after the US recovered, Europe went into trouble. And then emerging markets went into trouble. And every day when you open the newspapers and watch TV, you have a bit of good news, a bit of bad news, a bit of good news, a bit of bad news. But this is not what you're used to, right? In the 70s, 80s, 90s, you're used to investing when things were good and getting out when things are bad. But then you don't have consistency. You don't have a synchronized recovery, good news throughout the world. You have trouble spots in different parts of the world. And if you were to just invest based on headline news, what you see in the papers, what you hear, and that's exactly what happened in the last 5-6 years. A lot of people actually took cover, and a lot of people are sitting on a lot of cash, and that cash went into the property market to some extent, causing property prices to go up. A lot of the cash went to safer investments like bonds, and bonds prices have also done quite well. So stock markets have not seen as much in terms of inflows. A lot of people have missed that boat, right? And a lot of people are sitting on a lot of cash still, despite doing everything they've done. So that's the impression I get when I go and speak to investors, very high net worth individuals who've been just scared, because they say, I'm not used to this. The world is just one trouble after another trouble after another trouble. So what contributed to this huge rally? I mean, I think one factor that a lot of people have underestimated is liquidity, right? Because if you look at just purely fundamentals and valuations, you probably would not have bought a lot of things. But liquidity has been a big tsunami, a big driver, driving the markets. And going forward, over the next few years, I think liquidity will continue to remain a driver. So if you continue to apply the blue skies philosophy of investing in the markets and wait for all the good news to appear, all the bad news to disappear before you buy in the markets, you will continue waiting. All right? So that's one of the key messages I want to impart today. I want to just start my presentation with very quickly looking back at just the first quarter of this year. Just a very quick snapshot. You can see that equity markets, in terms of the MSCI Global Equity Index, is up by about 2.8%. Global bonds down by 1.3%. The US equity market is running into a bit of lethargy. Japan and Europe are doing quite well. Asia has done relatively well, primarily because of North Asian markets. But the question is this sustainable? Looking ahead into the investment and economic outlook, we think the world economy is recovering gradually. We are looking at a growth of about 3.4% for the world economy this year. It's not fantastic, because if you remember the 1970s, 80s, even 2000, world economy used to grow at about 4.5%, 5%. So what is 3.4%, right? No big deal. But you don't need the world to be too hot. You don't need the world to be too cold. What you want is to have a Goldilocks situation, which is exactly what we have right now. Not too hot, not too cold, because if it is too hot, then the central banks will pull the brake and you can't make the money. All right? So I think we have a situation now where it's not too hot, not too cold, perfect. Central banks are going to keep monetary policy fairly loose. And if you look at the Federal Reserve, you just focus on the Federal Reserve, of course you're going to get spooked because the Fed is talking about hiking interest rates. But if you look at the G3 balance sheet, in other words, it's not just the Federal Reserve, but other major central banks like the Bank of Japan and the ECB. If you put their complete balance sheets together now, compared to September 2016, which is roughly 1.5 years down the road, okay, we are projecting that that balance sheet will grow by about 23%. Okay, so even though the Federal Reserve may be on course for some kind of monetary tightening, I think the BOJ and ECB are stepping on the accelerator, and collectively, the amount of money out there in the system is still going to be quite large. So liquidity will continue to be a driver of the markets over the next couple of years. I think the other positive factor is commodity prices. They have collapsed. Oil prices are down by 50%. I think we've not seen the full benefits of that flow through yet. I think the decrease in commodity prices are very good for many parts of the world, and I think that will help to provide some kind of downside support for the global economy. I think US Fed policy is clearly going to be a key driver of financial market performance in 2015 and 2016. And the Fed is clearly going to keep a very close eye on the labor market in the US. And if you look at the labor market in the US, it's improved tremendously. Job openings are at a record high in the US. Unemployment rate has fallen to about 5.5%. So the Fed keeps a very, very close eye on the labor market, all right, to make policy decisions. And the labor market is doing very well. And if you look at wage growth in the US, this is an issue because wage growth in the US is running at about 2.1%. The problem is the US economy is doing relatively well. The unemployment situation is improved a lot, but the wages are stuck at about 2% growth. And this is what is holding the hands of the Fed. Right? The Fed has not acted yet because it's looking at the wage numbers and saying, okay, hang on a minute, wages are not going up as much as we want it to go up by. Right? But just because wages don't go up now, doesn't mean that they won't go up in the next 6 months, 9 months. Okay, because when they go up, they can go up very quickly. Right? There's always this lag effect. McDonald's, for example, in the US has announced that they've increased their hourly wages by about 10%. Walmart has done the same thing. Target has done the same thing. So more and more US companies are starting to hike wages. Okay, and if you look at this chart, what it tells you is that every time the unemployment rate starts falling below the 5.8% handle, the wage growth typically gravitates towards the 3%, 4% mark. Right? So while wage growth right now is fairly subdued at about 2%, the unemployment situation is getting tighter. More and more companies are starting to increase wages. And I think down the road, you could see wages picking up in a bigger way. And then the fear of Fed tightening more aggressively than expected could come into play. So this is a chart that shows you, basically a survey of companies as to what they're going to do 9 months down the road. And you can see that quite a number of companies are actually planning to raise wages. So although the current wage growth is not fantastic, down the road, that cannot be taken as a given. All right? Things will change. So how high can the Fed fund rate go? Right? I think the markets are at this juncture very complacent. Everybody thinks that the Fed fund rate is going to be very low for a very long period of time. Like what Professor Jeremy Goh talked about, interest rates are very low right now, but if you look at history, rates are probably headed higher, right? And we think that this year, maybe the Fed won't do that much because the economy is still slowly getting back on its feet. The Fed itself is not sure. But I think 2016, 2017, the Fed could actually act more aggressively if wages start picking up in a bigger way, and that translates to bigger inflationary pressure, right? So I think this year, maybe the market expectation and what the Fed is going to do is will not deviate very much, but 2016, 2017, the markets could be caught off guard. But if you look at past Fed rate hikes, you find that the markets typically, what happens is that a few months before the Fed rate hike, the market goes into turbulence. A few months after the first Fed rate hike, the market also goes into turbulence. But after a while, when the markets start to understand why the Fed is hiking rates, and the reason why they're hiking rates is because the economy is getting better, then the markets say, okay, that's good news. Okay, it starts heading up higher again. So there's usually a bit of turbulence before, a bit of turbulence after, but once the rationality for the rate hike is in people's investors' heads, that the economy is improving, things are going to get better, then I think, the stock market starts getting a footing and then starts heading higher. So you see that in 1994 to 1995, when the Fed increased interest rates by about roughly 275 basis points. about almost 3%. The Fed increased interest rates by almost 3%. At this juncture, I'm almost sure if you ask anybody here whether that's something they're even thinking about, the answer is probably no, right? But if you look back at history, it's happened, it can happen, and I think this is something we should not be complacent about. But the reason why it's happening is not because of inflation. The Fed may hike interest rates because of inflation, or the Fed may hike interest rates because the economy is getting better. If it's because of inflation, it's bad news, right? But if it's because the economy is getting better, then I think eventually the stock market we'll take it to mean it's good news. And what is the implication of the Fed hiking rates? I think one of the big implications is the US dollar is probably going to rally further. We've seen a roughly 15-20% rally in the US dollar over the last 12 months. But if you look at history, when the dollar starts rallying, it rarely stops at 20%. All right? Historically, it rarely stops at 20%. And you have to remember, the Federal Reserve and the rest of the world are going on completely different paths. The Federal Reserve is going to hike interest rates. It is probably going to tighten monetary policy down the road. The rest of the world is loosening monetary policy, including here in Asia. Central banks are cutting rates. So this big divergence in monetary policy between a giant and the rest of the world, I think is going to augur quite well for the US dollar. So while the US dollar on a week-to-week basis, month-to-month basis may take a break here and there, I think the multi-year trend is a higher dollar over the next few years. And a stronger dollar has got implications for commodity prices as well. Okay, a stronger dollar typically tends to move in the opposite direction of commodity prices. So higher dollar, stronger dollar leads to more expensive commodity prices, lesser demand for commodities. So if you're thinking of investing in the commodity sector, then you may want to think twice again, because a strong dollar is going to hurt the commodity sector. So where are the opportunities that we see? Between equities and bonds, I think I started my presentation sounding more positive on equities, and I continue to stay that way. I think we are still quite positive on equities going forward, because liquidity, for one, is going to be a positive factor. Firstly, stock markets are not expensive. If you look at the MSCI World Index, the stock markets over 2017 are probably trading at about 14 times P ratio. So this is not your 1999-2000 technology bubble where stocks were trading at 50 times, 60 times. If you look at the indices, the MSCI World Index, the valuation is still quite reasonable. And there's a lot of liquidity on the sidelines, right? Like I said, while the Federal Reserve may be increasing interest rates and possibly even tightening monetary policy in 2016, 2017, the BOJ and the ECB are likely to loosen policy further. It's possible that the BOJ could loosen even further after doing 2 QEs, and it's possible that the ECB could do even more as well, because the ECB's QE has been fairly small at this juncture because they're trying to appease Germany. But down the road, they could step on the accelerator. So I think liquidity will continue to be a supportive factor for financial markets, for the global economy. And if you look at this global savings rate, it is actually the highest you've had in the world. So a lot of people are sitting on a lot of savings, idle cash, that could go into the markets on a pullback correction. If you look at the US, you've got about $2.7 trillion sitting in money market funds. And typically money market funds are a temporary abode. People park their money there until they decide what to do. And so there's a lot of money actually sitting on the sidelines, which is what I told you at the beginning of my presentation. A lot of people have become very skeptical. They're just waiting for blue skies. But that's not bad, because that skepticism means that there's a lot of ammunition sitting on the sidelines. When you see a 10-15% correction, that money comes out and goes in. So in the last few years, for example, whenever we had mini crisis taking place, the markets fall by 10-20%, that was a buying opportunity. Right? But the problem with investor psychology is that many people shy away, run away. And if you look at Asia ex-Japan, you've got about close to $23 trillion worth of deposits sitting on the sidelines. So a lot of skeptical investors, skeptical about equity markets still. Among the equity markets, we are more positive on the developed markets compared to the emerging markets. I think I just want to spend a couple of minutes on this chart. Okay, we are clearly very positive on Europe and Japan, because that's where the monetary policy is the most aggressive at this juncture. In the case of the US, I think the Federal Reserve is going to tighten. That's going to create a bit of volatility. I think the US stock market has done exceptionally well. To expect it to perform exceptionally well from here on is unreasonable. But I think the US companies and US economy recover slowly. I think, a 5 to 10% appreciation of the US stock market from where it is right now is not an impossibility. My concern is really about Asia. I think, if the US dollar continues to hit higher because of expectations that the Federal Reserve is going to step on the brakes, then a stronger dollar may not be the best thing for Asia, because Asian currencies will depreciate against the US dollar, and that could cause capital outflows from Asian financial markets. Because Asian financial markets have benefited tremendously from the Federal Reserve's QE and the weak dollar, right? The weak US dollar. But going forward, I think if the Fed tightens and the dollar strengthens, emerging market currencies weaken, that could result in capital outflows from the bond markets, from the equity markets. I think the other factor to consider is also that a stronger dollar might hurt some parts of Asia, because I think the very weak US dollar in the last few years has resulted in several Asian countries, companies actually borrowing heavily in US dollars. Okay, so if you pick US dollar borrowings outside of the US, it's increased 50% between 2009 and September of 2014. Okay, so a lot of people have been borrowing US dollars thinking the dollar is going to stay weak, but if the dollar continues to appreciate, it's going to hurt companies in Asia, companies in emerging markets that have borrowed heavily in the US dollar. So for those reasons, we are a bit cautious on Asia. Here in Singapore, the stock market, I think, has not done fantastically well, but the ST index is up by about 4-5%. But in terms of US dollars, the stock market performance has not been fantastic. The ST index in US dollar terms has gone up about 3%. Okay, and the only other markets that have done worse than ST in US dollar terms is really the Jakarta stock market and the KL stock market. But other stock markets like the North Asian markets have done fairly well. But still, I think Singapore will have a place in investors' hearts, global investors' hearts, because I think one thing Singapore offers is attractiveness in terms of companies with good corporate governance and yield. There are a lot of yield stories to play in Singapore. A lot of fund managers that I speak to in the US and Europe, they like Singapore because of that yield. So in summary, the US is set to end its zero interest rate policy. When this is going to happen, I think nobody really knows. I think June looks like it's unlikely to happen. More likely September, maybe December. But whatever it is, it's quite clear that the Federal Reserve cannot backtrack. It's already set the market into motion, expectations that, they're going to hike rates and they will have to do it. And the labor market indicates that they will do it. And so with the end of QE3 and the new Federal Reserve, I think you're going to see a lot more market volatility, because the Federal Reserve has expanded its balance sheet by leaps and bounds. So when they start backpedaling, right, it's like the tsunami effect. You will see some volatility, quite a bit of volatility, and some dead bodies along the streets as well. So remember, the US is tightening and the rest of the world is loosening. So there's a big divergence in monetary policy, and I think that's going to create a lot of uncertainty, a lot of volatility. So in the next 1-2 years, you will see the markets going into quite a bit of volatility, especially after the Federal Reserve starts hiking rates. Because then the markets are going to say, okay, the Fed has started hiking rates now. How much will the Fed hike rates by now? Will they do it slowly? Will they do it quickly? And all that will play on investors' minds and create quite a bit of volatility. But I think we are still quite positive on Europe and Japan, because we think that the party is just kind of beginning over there. I mean, QE is still ongoing. They are loosening monetary policy, whereas the US is tightening. So those two regions still look quite okay. China, we don't think it's going to pose a big risk at this juncture. China is slowing down. We see 7% growth. I think the current Chinese leadership wants to ensure 7% growth, and it's very possible that in the next 1 year or so, China could continue to ease monetary policy, right? Because despite what they've done so far, it doesn't seem to have helped the economy tremendously. It's slowing down, and so the PBOC and the Chinese government could ease policy further, and that could actually spur Chinese stock markets even higher. So abundant liquidity in the system, that's going to look for a home, and that's going to provide downside support for the markets. So markets is going to be a lot more volatile. I just want to emphasize again. I mean, right now, nobody's talking about Federal Reserve hike. There's a lot of complacency in the market right now. All right, but when it all starts, you will see a lot of volatility, a lot of turbulence, a lot of fear, and this will start playing into investors' minds. But remember, volatility is also an opportunity, right? Because as in behavioral finance, right? Be greedy when others are fearful, and be fearful when others are greedy, I guess. That's the moral of Professor Jeremy Goh's story. One of his morals, I'm sure. But, and you've seen that in the last 5-6 years. There have been several mini crises, and the markets have pulled back 10-15%, and that was an opportunity to buy, or nibble, buy, and hold on. But I think the problem is that for most investors, when they see bad news, they run. When they see good news, and the markets are high up there, they want to buy. Right? It's the complete anti-retail philosophy, which is like when shopping centers give you discounts, right? You jump in and buy, but in the stock market, when there are discounts and big discounts, people don't buy. So between the asset classes, we are more positive in equities compared to bonds, but it doesn't mean that we are saying throw all your money into equity markets. I think asset allocation, diversification is still very, very important. And finally, like I said, we're actually more positive on developed markets at this juncture. It doesn't mean that we are negative on the STI. It just means that on a relative basis, we probably see more money being made in some of these other regions like Europe and Japan. And I'm sure there are ETFs and unit trusts and other products that you can consider to participate in that macro view. Okay, with that, I thank you very much.